Hi everyone, I'm Paul and welcome to my review of Lesson 25 of ICT's 2022 Mentorship Program. Today's video is essentially a crash course on everything that's taught in the model for the 2022 Mentorship Program. It's going to be very information dense, so don't be surprised if you have to watch it through a few times to make sure you capture everything. This review will either help to fill in any gaps that you might have or bring everything together and help make it all make sense. So make sure to take some notes as you watch. If you enjoyed this video, please hit the like button to help other people to find it. And if you haven't already, don't forget to subscribe to my channel and turn on notifications so that you never miss an update. These are simple and free ways for you to support my channel. And if you want to stay in touch and join a community of like-minded traders, click the link in the description to subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's dive into today's video. Today's video is lesson 25 of the 2022 ICT Mentorship Program. And as always, we'll just go through a brief outline of today's video. Today's video is going to be really information dense, so I think this outline is going to be really helpful to bracket some of these concepts and help break them down into, more consumable chunks as you go through this particular video. So don't be afraid to come back and reference this outline as you go through the remainder of today's video. And so the other thing I've done with the outline today is I've actually used the charts that we'd be looking at as we go through each of these steps to sort of aid in creating a broader structure that you could follow as you go to start implementing this into your trading journey yourself. So we'll start at the daily chart, we go down to the hourly, the 15-minute chart, and then the 5-minute charts and lower. And so this is just a logical structure to follow. And then I guess the various things you'd be implementing on each chart, which as I said, we'll be covering in today's video. So the first section is the daily chart, and this is where we'll be determining daily bias using seasonality and liquidity concepts that ICT has been teaching in the mentorship program. Next, we'll be looking at the 1 hourly chart, and as well as building on some of those concepts from the daily chart, we'll also be introducing rebalancing and the midnight open. We'll then move down to the 15-minute chart, which ICT often calls his bellwether chart. And this is where we'll see daily bias in action. And this is where we're going to be implementing our daily bias through the power of 3 and Judas swings, and also looking at whether we're in a premium or a discount market whilst we introduce the 8:30 open. Finally, we'll zoom right down to the 5-minute chart and even lower as we start to move into execution. So again, we'll be looking at the Judas swing, displacement, concepts of equilibrium, and then of course our fair value gap, which is what we use for entry, and we'll be talking specifically about where we put our limits and where we put our stops, and of course where we would potentially be looking to take profit. So with that out of the way, let's jump into our charts. So in today's video, we're going to be using the S&P 500 or the ES throughout the video. And we're going to start on the daily chart, and this is where we're going to be trying to determine our bias. Now, if you've been watching the mentorship videos up to this point, you'll know that ICT has talked at length about how he has a bearish bias, and this particular piece of price action here we've covered a number of times in the last few videos. But what I'm going to do now is just really go over an approach on how to perform daily bias, because I know a lot of people struggle with this, and these are just some of the points that I use and I think are really helpful to make this an easier process. So the first thing I think about is, where is the next draw on liquidity, and where has liquidity been and where is it likely to go? So if we look at this particular example, you can see the market's traded higher, and then we've taken out this buy side liquidity here, these relative equal highs. And so this is where liquidity has been. And so then we start to look at where is liquidity most likely to go. So it's most likely to draw towards a bullish fair value gap like we have down here, or sell side liquidity like we have down here. So that's where it's been and where it's most likely to go. The other question I like to ask myself is, where would smart money be buying and where would they be selling? Because this is generally in the area where we want to be buying and we want to be selling. And so the reason why that's important, if we look at this area up here, so this is where we have our buy side liquidity, our relative equal highs. And so why this is important is the more highs we have in this area, the more buy stops we know have accumulated in this area, so the more liquidity is present there, which is just going to make that more and more attractive for smart money to sell here, so to get short. And then the opposite is true on the sell side liquidity. So you can see down here, we have these relative equal lows, and then we have this sell side liquidity here. So we also know there's going to be a very big pool of sell side liquidity, so sell stops residing down here. And so this is an attractive place for smart money to be buying or to be closing out their short positions. So the thing that we need to be doing as we move through this decision process in terms of formulating our bias is starting to build a narrative through confluence. So if we have this first question around where has the liquidity been and where is it going to go? Where do we think smart money will be buying and where do we think they'll be selling? We can start to merge those two narratives together and start to try and build a picture. And so this is also where we can start to layer on other concepts like seasonality. So in this particular piece of price action, we're coming into May. Now, historically, May has a seasonal tendency to be bearish. So just because that's historically happened doesn't mean it will always happen, but we do have an expectation in that we won't really be surprised if we do have bearish price action in this period. So in this particular section, we're looking at, the last couple of weeks of April. So going into that period, we wouldn't be surprised if we had bearish price action. Now, again, we layer what we can see on the chart with this. We have a bearish order block that's formed just here, and we've talked about this in a number of the lessons in ICT's mentorship so far. And just inside here, there's actually a bearish fair value gap as well, even though it's very, very small. So you can see as we come into the end of April and as we're approaching May, we trade back up into this zone. So if we were just looking at this day here after this particular candle, there'd be a lot of confluence and a lot of interwoven narratives that would start to paint a bearish picture. So we would have the residing buy side liquidity here, which we've tagged, which we know is where smart money would be selling into that buy side liquidity. We know we're coming into May. We also have a number of setups being our bearish order block and our bearish fair value gap that start to position us for bearish price action. We also know that we have a bullish fair value gap lower, as well as relative equal lows, sell side liquidity resting down here. So as we mesh all of those particular points together, we start to build confluence and we create a narrative that we're expecting lower prices. So our bias is bearish as we go into, the next days and weeks until we've actually met this objective, which is taking out this sell side liquidity down here. So as we move through the price action, you can see after we've moved up into this zone where we have this bearish order block and this bearish fair value gap, you can see that the market reacts, very strongly to that. We draw straight down into this bullish fair value gap. We consolidate there for a little bit before we, punch through this sell side liquidity down into this liquidity pool residing down here. Now we trade back down and up into the bullish fair value gap before reacting to that level again, and then trading strongly lower, and you can see we actually gap even on this candle just here. Now for the rest of the video, we're going to be focusing specifically on the price action here on the 10th of May. So you can see this is what would classically be called an indecisive candle, because we have kind of this spinning top pattern that the candle has painted after we've had this really strong move of 3 back-to-back down close candles, specifically this one and this one. And the things we want to pay attention to in this particular price action around here is we have this swing low here and we have the low of this candle. So this is actually Friday's closing candle, and you can see this is the low of that candle just there. So you can see it doesn't quite go lower than this swing low here, but then the next day's price action, you can see this is a really strong down close candle. It's quite energetic. It takes out this short-term low. We obviously go lower than this low here on the previous day candle, and then we get the next day candle, which is obviously the Tuesday. So this is Monday and then Tuesday, and this is that indecisive candle that we talked about. We do go lower, but we also trade right up and we actually rebalance all of this price action from the Monday, and we'll look at that now as we go on to our 1 hour chart. So on our 1 hour chart now, we can start to see the formulation of the 2022 mentorship model even on the 1 hour chart. And so what we have is buy side liquidity residing here, so relative equal highs. So you can see we have a number of candles and the highs are relatively equal. So as we come into the trading day, you can see we take out those highs, and this is that candle that trades right up, and this line represents the low of that candle from the Friday. So this move rebalances all of that price action from the previous day, which is Monday, which was a significant down close candle. You can see we get a displacement, so we get this energetic price move down, and that breaks market structure. This is our swing low that we break here with this particular move on this candle. And then we have our fair value gap formed, even though it's on the 1 hour chart. So it's our 1, 2, and 3 candle formation, and we get our bearish fair value gap formed between the low of that first candle and the high of that third candle just there. The market then continues to trade lower. We take out this sell side liquidity, so we tag that just down here before we trade back up into that fair value gap. So the liquidity, the next draw on liquidity is up into that bearish fair value gap before the market starts to trade away again. Now, whilst we're on the 1 hour chart, we're going to also introduce the concept of the midnight open. The important thing to remember with ICT's teaching is everything is done on New York time, and time is one of the primary, components of the whole setup. So we work on time and then price. And so midnight New York time is the first open that we look at, and we're interested in terms of what does price do after that midnight open. So you can see we have the open, we trade above it, we take out this buy side liquidity, and we tag that low from the Friday. And so as the market comes up into this level, we know that we're in a premium market. So we've zoomed into our 15-minute chart now, and this is where we're going to implement our bias. We're going to start to see that daily bias come into action. So remember, whilst we're looking at this 15-minute chart, we have a bearish bias. And so this is important as we start to bring in the concepts of the power of 3 and the Judas swing. So when we have a bearish bias, what we're expecting as we come into our opening part of the session is we're actually expecting price to go up. And this is the Judas swing that ICT teaches throughout the mentorship. And this intertwines with our second open, which is the 8:30 open. So you can see here we have our midnight open here in purple. And again, remember, this is all New York time. Then we have our 8:30 open, which is here red, again, all in New York time. And so what we can see is the market trades above the midnight open. We come back to the midnight open before we take out these relative equal highs, this buy side liquidity. We trade back up, rebalancing that large move from Monday, and we tag the low from the Friday. And this is our Judas swing. So we've gone above our midnight open. We've traded way above the 8:30 open as well. So we know that we're in a premium market. And so the market, is really expensive. And so at this point, we know that we're above this buy side liquidity, these relative equal highs. So we know that we've gone, deep into this liquidity pool that smart money will be using to sell into. And so remember, this Judas swing is what's designed to, trick the market or traders or other participants into thinking that price is going to go higher. So you can see we've taken out these relative equal highs. We've also gone up into the low from Friday after these, consecutive down close candles. So that's all just drawing more and more participants in so that smart money can get short and position themselves to the downside. So at this point, we've done our analysis. We have a bearish bias. We're expecting lower prices. We've zoomed down to the 15-minute chart, and now we have even more confluence, and we have a setup forming that all indicates that the market is going to go the way we expect, because we're expecting the market to go higher at the open before trading lower. So now we need to zoom into the lower time frames, that being the 5-minute chart and lower, to start to look at opportunities to enter using our fair value gap that we've been using throughout the mentorship program. So zooming into our 5-minute chart now, this is where we start to look for our fair value gap setup, and we're specifically looking at displacement after we've had that liquidity grab. So on the 5-minute chart, we can just see even more clearly, we have our midnight open just here. We have our 8:30 open here, and you can see how prices traded above the midnight open. We've created these relative equal highs, this buy side liquidity here, before trading back down to the midnight open price. And then as we've come into 8:30, the market's rallied. You can see we've taken out this buy side liquidity, and we've traded right up into that level from Friday. And so this is right when the 9:30, so the actual equities open has occurred, and you can see we get this, volatility as we go into the opening rotation on the equities market. Then we get the market pull back. So this is the classic Judas swing that we talk about. So in terms of our power of three, so this is exactly what we want to see when we're bearish under our power of three. We want to see the price go higher at the open. So this is where we're going to have smart money accumulating short positions before we get our manipulation lower and then our distribution down at our sell side liquidity at the end of the day. And so still on our 5-minute chart, this area in red is highlighting the displacement. So this is from the high all the way down to the low. And so this is this displacement move. This is that energetic move lower, which is going to break market structure. So you can see we have a few breaks here. We have a swing low here before we take that liquidity. And we also have one here. So this move breaks market structure at both of those points before trading higher and then going lower. So on this particular chart, so on the 5-minute chart, you can see we have our fib running from here to here, and we have equilibrium just here on this blue line at the 50% level. So we'd be anticipating that we'll have a fair value gap somewhere around this level. And what we're looking for is for a fair value gap that's in a premium market. So that's anywhere above that equilibrium point. And this is really important because we don't want to be taking a short position down in a discount. We want to be shorting in a premium market. And so that sets us up for a much higher probability trade. So again, on the 5-minute chart, whilst we have all the ingredients, we actually don't have our fair value gap forming. You can see all these candles are overlapping here. And so what we need to do is now start to zoom in, go to the 4-minute chart, and we keep going down lower and lower until we find a fair value gap on one of the lower level charts. And so we're on our 4-minute chart now. So we've gone from the 5-minute down to the 4-minute. And we still have that same piece of price action that we've been looking at all the way. And we've got our equilibrium marked out here. Now you can clearly see that there's no fair value gap in this particular piece of price action, in this displacement we get in this area of price action here. And so again, we need to go down to the next level and we just keep going until we find a fair value gap. So this is the exact kind of process that you should be going through when you're actually enacting this in your own trading. So you should be moving down those levels from the 5 down to the 1 minute until you find the first fair value gap. And so on our 3-minute chart now, you can see we actually have a fair value gap. We've got the first one that we've seen as we've started to zoom down. The only issue with that is that the fair value gap is actually in a discount. So you can see that's the fair value gap there. So we have our fair value gap set up being our 3-candle formation. So 1, 2, and 3. So we actually do have a fair value gap. You can see the market trades into that, but it is below equilibrium, which means it's in a discount market, which means we wouldn't take it. So this is a hard and fast rule. And even in this example, you can see why. Is because if you took this setup, you would have your stop either at the high of this candle. So if we just mark this out here, you would either have your stop just here or potentially at the swing high here. And you can see either of those stops would have been taken out as the market retraced part of this move before going lower. And so that's really like one of the worst things that can happen is you've done all this analysis, your bias is correct, you're actually looking, you're here at the right time, but you just don't get your entry right and you get stopped out before the market starts going exactly where you thought it would be. So again, this is a hard and fast rule to protect you from that kind of eventuality. So we need to now zoom in to the 2-minute chart to see if we can find a fair value gap in a premium market. So we're on our 2-minute chart now, and finally we've got a fair value gap that we can use. So you can see here we have, again, the same piece of price action that we've been looking at. We've got this energetic move here, this displacement. We've got a fair value gap here, as we did on the 3-minute chart, which is below equilibrium, so we can't use that one. And then we have another fair value gap just here, which is above equilibrium, which means it's in a premium market, which means that we can use it. So let's just mark that out now. And so it's our 3-candle formation, so 1, 2, and 3, and the fair value gap resides between the low of the first candle and the high of the third candle. And so if we're looking to trade this particular setup, we would have our limit sell order here at the high of that third candle, so that's where we would be selling. And then we would have our stop either at the high of that first candle, so up here, You could potentially also have it at the swing high here. And in the video, ICT also talks about having the stop at the high of that candle too. So under the rules, all of those things are fine. And it really just comes down to, what level of risk you're comfortable with, how much you've tested it, and how confident you are in this particular setup. But all three of those are options. I personally would probably use this particular one, the high from the first candle, and potentially even this one if I felt the move wasn't as strong. But certainly that would be the one that I would most commonly use, would be the high on that first candle. And so one of the next obvious questions is, where would you be taking profit once you're in this trade? And so the answer to that is sort of, it depends. So it depends on where you actually got set. So you can see after the fair value gap forms, we immediately trade back into the fair value gap before we trade lower. And so if that was the case and you actually had entered just here on this candle, you could potentially be looking to take all your profits here. That's the low-hanging fruit that ICT talks about, and that's a very quick trade. You're in and out, and then you could be potentially done for the day at that level. You could also look at trading into this fair value gap that we have here. So remember, we're just really looking for where the sources of liquidity are going to be. So we've taken out the buy side and we're now looking at the sell side liquidity. So you can see our first level of liquidity would be down here, which is pretty much confluent with that fair value gap just there. And you can see how the market reacts to that. We trade back down into this area before we retrace, and then we come back into the fair value gap again. You can see the market has reacted here. And so this is why often it makes sense to take partials at this kind of level, especially if it's at a take profit level that you're comfortable with. You can have then the balance of your trade to then run to pick up any potential upside. So in this case, it does trade higher. So you could be potentially entering here for the first time. So if you hadn't got set here, you could potentially be entering just here because you maybe didn't pick up the move initially. So again, you would still be using this lower band here as your limit, and then you would be trading lower. And again, you would be targeting the next sell side liquidity, which would be down here. So again, you could be looking to take partials down here. And once you've traded down to this kind of level, you can see we've painted this swing high here. You could then start to look at moving your stop and potentially move it, to break even, or you could move it down to, the highs here. Because once we've traded and taken out this swing low just here, we've had a distinct break in market structure. And so it would be very unlikely for the market to reverse. And if it did, that would just mean that our bearish hypothesis would be wrong anyway. And this is why ICT often talks about taking partials. And so this way you're actually paying yourself first. So you're ensuring that even if you are wrong, you've still taken some money out of the market and you've managed to pay yourself. So again, in this case, you could have taken all of your profits at this level, or you could take a partial, and then the next source of the liquidity that we'd be targeting would be that significantly lower level of sell side liquidity, those relative equal lows that we're talking about on the 15-minute chart, which is all the way down here. So if you're really brave, you could obviously hold out for all of that move, but it makes much more sense to take some partials, let some run, and then just adjust your stops accordingly as we've made those significant market structure shifts. Thank you for watching my review of Lesson 25 of ICT's 2022 Mentorship Program. I know there was a lot of information to take in today's video, and for some people I'm sure it felt like drinking out of a fire hose. If you did, that's okay. Just make sure you watch the videos a few times, and I'm sure some of these concepts will all start to crystallize for you, and I'm sure it'll be helpful in solidifying your understanding. If you enjoyed this video, please hit the like button, because that helps other people to find it. And if you'd like to see more content like this, make sure you subscribe to my channel and turn on notifications so that you never miss any updates. And just a reminder, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description, which allows you to subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.